welcome back to another video on the channel. Portfolio is currently sitting at $8,441.78. For the day, we are up 46.80 or 0.56%, down $10 after hours. For the week, we are up 155.76 or around 2%. For the month, we are down 62.43 or 0.73%. For the 3 months, we are up 461.32 or 5.78%. For the year to date, we are down 296.39. For the 1 year, which is the all-time chart, we are up $322.37 or 3.97%. So we are still staying afloat, as you can see on the all-time chart. For the week, we did end green, but you can see we gave up a lot of these early SOFI gains that we had made early on in the week on Monday. You can see, or I suppose it was more SOFI and TSLL, but a large part of this initial run-up was due to SOFI's earnings report. So, which, by the way, they smashed it and also upped their expectations. So we'll be going over how that has affected my interest in the stock in terms of acquiring shares in a moment. But you can see it popped all the way up $460 on Monday, which is amazing, and even continued into Tuesday at one point being up $470 in the week, which is insane. So we're up to 8,756, which is definitely not an all-time high, but very close to one. So I was feeling very confident and excited. You can see this really sharp line, which including Tuesday was even higher than that, probably up to right here. So things were looking really good at the beginning of the week, and then we had a sort of slow melt-off. We had the Fed meeting on Wednesday, which I believe was the 30th, where Powell had essentially said, I believe he said they potentially weren't ready to cut rates in March, which sent the market down, and then it kind of continued a little bit flat, at least in my portfolio. And then towards the end of the week, I know the S&P began to recover and sort of rally. I didn't see that as much in my portfolio. We kind of just traded flat after Tuesday. So that's where we're at right now. At least it was a green week. We'll always take that regardless. But let's go over the positions. So I'm going to go to total return here. We have a Riot $10 put for this next Friday. We have 2 SOFI 850 calls for next Friday. We have 2 TSLL calls for next Friday. We have that CVE call credit spread for this Friday, or I guess this is the next Friday after this, so in 2 weeks. We have a SOFI $7 put for 2 weeks out, SOFI $5 put, 2 of these for 2 weeks out, SOFI $6 puts for 2 weeks, or this 3 weeks out, and then TSL 750 put 3 weeks out. And if we look at so that's on total return, look at the equity, you can see we have quite a lot of equity here as well. In terms of price, you can see these puts are entirely worthless, but I don't plan on closing them out because I have nowhere else to put the cash right now. So there's not really any point to close them out or to keep them open. I don't know, kind of just leaving them as is. And this CVE call credit spread is still not worthless, which is kind of crazy. We can, I guess, check out the stock. I haven't really looked. You can see the stock is at $15.83, so the fact that this is still worth $7 is kind of crazy. But yeah, no. So big thing you'll notice is I sold 2 SOFI covered calls, which means that I have 200 shares of SOFI, which is true. You can see I currently have 220.75 shares of SOFI, so I added around 105 shares this week. I added 100 more shares at the 850 strike. I sold an 850 strike put expiring this Friday, which ended up in the money. So we ended up getting assigned an additional 100 shares of SOFI, which is great. So now we have 200. We can sell 2 covered calls at the same time. You can also see my free share count has gone up quite significantly since the last video. We now have 9 entirely premium-based free shares on TSLL, 20.75 on SOFI, and 6 on Riot total. And let's go into SOFI here. The average cost is now sitting at $7.59 for 220 shares. Once again, this is very incorrect because not only was our initial assignment, or I originally bought 100 shares at $6.75, but also when I bought my extra shares because of the assignment this week, I didn't actually let the put get assigned, so it's not based on the strike price, it's based on the price I ended up buying it at. So this is entirely inaccurate. I believe my actual cost basis, and we can check this doc, should be, or unadjusted cost basis rather, is, well, I'm just calling it 8. I believe it is probably more in the low 7s, but I'm just going to call it 8. And of course, adjusted cost basis is lower than that. But right now, we're just going to call it 8 as our current cost basis. So you can see we're right below that. And I'm selling calls at the 850 strike, as you can see. And we have quite a lot of SOFI options open, as you can see here. But we are selling those 850 strike calls, so way above our cost basis, our original cost basis. Not to mention, we brought in $152 in premium on SOFI alone. So if you were to factor that in, our cost basis would be 75 cents lower than that, meaning we're up, I believe that's around like $120 on SOFI. and even that is a little bit high for my actual cost basis, so probably even more than that. But yeah, no, so I acquired another 100 shares so I can sell more covered calls. I also adjusted my acquirement prices, so you can see I have moved it up. So I moved one to 850 to make sure I could get more shares at that. I have one at 7 and I have two at 650. I may end up moving these again to be higher. I might do a 750 and then a 7 and then a 650. And the reason being because they are now a profitable company, so you have to look at them from that standpoint. It's totally different now, considering their price is the same as before, and they are now profitable. So you have to consider that profitability, and the expectations they set at their earnings call were also very positive. So you have to consider that too, that I believe this stock will increase in value over time significantly, and especially with that earnings call affirming that, I can now feel more comfortable to move up my acquirement targets, if that makes sense. But as of now, these are the current acquirement targets. So we've officially been assigned on SOFI at 850, TSLL at 1223 and 10, and Riot we are still yet to get assigned on. I've still been collecting a ton of income on Riot, which is really nice, I can't lie. If we go over and look, we have collected $82 on Riot without any kind of assignment. I've just literally been selling the $10 strike every single week. I even sold another one today because the previous put that I sold at the $10 strike from last week that expired today expired worthless, or I was closing it out for $1, so bought that back for full gain, and I sold this one, turned around and sold the same exact strike for one more week out today, and you can see that reflected here. Here it is. We got paid $10 to sell this contract, and it expires next Friday, and it's at the same price that I've been trying to acquire it at for a few weeks now. You can see here. But what's really good about that is that it means if I do end up getting assigned at $10, if you adjust it for that premium, my actual cost basis will be around $9.18. So that's really good. That's really solid. And my plan is to just continue to do that. It's been working really well so far. We can also look at the rents on my other stuff. So TSLL, been bringing in a lot here, as well as SOFI. And then my average premium income has been really high. This week was definitely lower, and I would say that is mainly due to the IV crush on SOFI, so I'm not able to pull in as much premium, as well as the IV crush previously from TSLL after their earnings last week, Tesla's earnings. So we're not having as much IV, and therefore we're not getting paid as much to sell these contracts. But regardless, $50 a week is an incredible return. Especially if these stocks recover to my original cost basis, we get to keep all of this premium for entirely free. Not to mention I'm reinvesting all of these premiums back into the same stocks. So if it does recover back to that original cost basis price, not only do we have no capital loss, but we were able to keep all of this premium, and the additional shares we were able to buy with this premium, we also get money back on because they also rise in share price. So that's kind of the idea behind this, is we collect all this income, and then we're picking quality stocks that we think will do well in the long term. So even though right now TSLL is looking a little bit dire, you can see, and when I say dire, that's kind of ridiculous, but it's sitting at 924. As you know, I originally bought at 1223 with 100 shares, then I bought another 100 at 10. And it's down at 923, which looks really bad on paper, but if you consider the sheer amount of premium we were able to bring through the door, I mean, if this stock is able to recover back to my original cost basis, when you combine those two prices together, then not only do we recover this full 241, which it's actually more because I ended up buying the shares outright, not getting assigned. We recovered that full capital loss, but we also get to keep this entire premium. Plus, we bought those the additional 9 shares for free. That'll also increase in price by $3, whatever the price is, to give us additional gains, or if our calls get blown through, our covered calls. So yeah, that is the idea. Once again, this is an experiment. I've gone over this in my previous video. I understand that investing in the S&P 500 long term is probably the best option. This is just an experiment to see how it goes. Another crack at doing the wheel strategy. And it's just more fun, to be honest. It's more enjoyable than buying and holding, if I'm being totally honest. Being able to collect all this premium each week has been very fun. But if we look at this, our total yield for the month of January is around $300, which is crazy. So that's a lot of income. Our average weekly yield is around $59, and considering we had basically nothing going on the first week, you could really probably just get rid of that first week and look at it more from a standpoint of just these 4 weeks when I've actually been doing it properly, which would just be dividing that by 4. You can see we average around $75 a week, which is crazy, and that obviously adds up. That's 3% monthly, around $270, and annually that comes out to around $3,200, which on an $8,000 portfolio is around 36%. So that's really crazy. I don't expect to maintain this, but it's possible, which is why we're collecting all this data so we can get a broader picture. Once we have February's data, maybe we'll see. Maybe it'll be higher average, maybe it'll be lower average, or maybe it'll be about the same. And regardless, I think it'll be a lot of money. So I'm excited to see that. And this is the closure of January, so that'll be this coming week will be the start of that. But yeah, I think that's everything covered. Let's see, new positions I opened, I believe was, so I opened the 2 covered calls on SOFI yesterday. I opened the 2 short puts on SOFI today. I opened this short put on TSLL today. I opened this short put on Riot today. And I believe that's about all of the new positions I opened this week. I'm sure these might be included, I'm not sure. The January 31st definitely was, so a 7 strike put on SOFI also added that this week. And that 850 strike put. But yeah, no, so that looks to be about everything. Tune in next week to see how the first week of February goes in terms of premium collection and in terms of gains. But we're looking good. So yeah, thank you for watching this video, and I'll see you in the next one. Goodbye.